Federal Reserve is experiencing its worst nightmare, and that is an unraveling of an economy, an unraveling of their system of checks and measures, an unraveling of their ability to be able to insert confidence in the US dollar and their loan system. Banks are panicking, and the interbank lending rate is not rising like it has in the past. I want to talk about how we have cracks in the economy and how the recession is already in full swing. And the proof is that the Fed has just injected billions of dollars into the banking system. And then I want to explain how you can actually take advantage of this. Okay. A lot of people online will tell you that the banks are closing their doors. You're going to lose all your money. I will tell you this. I personally do not believe that. I do not believe banks are in the business of taking people's money because they'd be out of business real quick. And the Federal Reserve wants to keep this system going because they're honestly printing money for free, taking all the wealth of the world and making the middle class and the poor even poorer. So why would they give that up? But there are things you can do to protect yourself because there are going to be people that lose money that have too much money in the banking system. So let's talk about cracks in this current economy and how you may have these signs. So first off, recessions always look obvious in hindsight. Yep, we're in a recession. Or, oh yeah, we were in a recession in 2008. The reason why is because there's an actual announcement from the government that comes out and says, we're in a recession. And the definition, I actually have to say the old definition because I haven't heard it change yet, was two or more quarters of a weakening GDP growth. President Biden literally changed the definition. He said that's not it, because we were already headed down that road. But at the same time, there's being so much money pushed into the economy, most people couldn't really see it or figure it out. And since there wasn't an official announcement, it never came. The thing is, when you're talking about recessions, because of the 2 quarters or more of slowing or declining GDP growth, that means it's a lagging indicator, right? On top of that, GDP is made up of a handful of things. And one of those aspects of gross domestic product are government spending. And you and I have both seen government spending money like crazy, like drunken sailors. So that tends to keep the numbers up. Now, I will say that since we've had such a long shutdown, and I don't think anyone is thinking about this, because GDP is primarily made up of government spending, we're going to see this 30, 35, maybe 40, maybe even 45-day period where the government was severely hampered in its spending. I've been a government employee for 23 years. I know how this works. And what's really interesting is that data is going to hit around the first and second week of January, showing how much less the government spent into our own economy, right? Buying weapons, products, food, all this stuff for the military. Those numbers are going to be severely smaller. So that data is going to hit Wall Street about the same time that all the data from the October 10th crash of the stock market and crypto. And there was more money, when you're talking crashes, there was more money lost in one day on the 10th of October in the stock market than there was during the day of the Lehman Brothers takedown. So you've got to think that in January, all of this stuff is going to be hitting the forefront of Wall Street investors and retail investors. Now, when you think about on the surface, a lot of things look strong. The equity markets are high. The current labor market, it still appears pretty robust, even though we're getting all these stories of layoffs. There's still like this shimmering hope. But the sad thing is right now, the shimmering hope is AI. And we all know that AI is taking jobs currently. So it's all about the flow of money. You've got to look at where money's flowing. And where do you look at that? Well, the easiest way is to look at retail sales. And everybody every year on Wall Street focuses really hard on the fourth quarter of the year because that's when Black Friday happens. The whole all year long companies are usually in the red. And then people just spend like crazy at the end of November. And then that usually kicks them up into profitability, into the black. It's a real thing. It affects humans, just like lunar cycles. I can't get over it, but it's a fact. When the moon is so strong to be able to pull tides out into the ocean and then push them back in because of the gravitational pull on the water, since humans are mainly made of water, we have that same gravitational pull. That's why we see crazy people coming out during the full moon. So where is that money flowing? The biggest thing to be able to see, and you're going to be able to see it soon, is those retail numbers. On top of that, January is such a key month to be watching this because, like I said, all that data flows through. And the question is, where are you going to be sitting? Are you going to wait for an official government announcement that we're in a recession? Because what happens when the government says, okay, we're all in a recession? Humans just slow down and stop buying stuff. Now, they don't stop because they're still going to eat and stuff, but they don't go on as many vacations. They don't do all this stuff because they are reactionary. Most humans are reactionary. They're not proactive. So this isn't the time to be getting into debt. This is the time to be paying off debt, getting your credit score super high, as high as you can from all these little tricks of the trade. There's lots of them out there. And then what happens as the recession hits, banks immediately start to really ramp down their borrowing or the lending. They're already starting to do it right now because you're seeing when the Fed lowers their benchmark rate, you see mortgage rates actually tick up. Because when the Fed lowers rates, that's a sign to the banks to go, hey, you know what? Things aren't looking good. The Fed never lowers rates when things are good. So we don't want to charge, rock bottom prices on mortgages, because what if the people that we're lending these things to, they don't have a job next month? They may not be able to pay us. And so you want to be in as little debt as possible with the highest credit score as possible during these times, because what happens is everything goes on fire sales. We're already seeing it in Facebook Marketplace, Craigslist. People are selling their nice items rather than going out and hoarding those and buying more. We're seeing sales of watches falling off a cliff. I mean, people go out and they buy these things and they don't, they go take loans on their house against their house for these things. I can't get over it. And they go and spend money frivolously, money they don't have, just to impress other people. Well, instead of buying those things, we're seeing companies like Rolex and other companies numbers completely drop off a cliff. We're seeing high-end cars dropping off a cliff. I'm already driving by auto dealers and seeing 0% rates, teaser rates now. This is the sign that the economy is cracked. We're in a recession. We're just waiting for the official announcement. I hope you got something out of this. I'm curious what you think down below. Let me know if we're already there. If we're not, maybe I'm completely off. But I think this is the time to be getting ready. All right? Hopefully you got something out of this. The Economic Ninja is out.